In late 1929, the richest country on Earth hit a wall. No bombs, no invasion, just a market that stopped making sense. By the time the dust settled, money itself had become the battlefield. What followed wasn't just a downturn. It was a worldwide fight over gold, debt, and control that rewired how the modern economy works. You won't see this version in a textbook. The Great Depression wasn't only about falling prices, it was about who gets to decide what money is and who pays when it breaks. By late 1929, the signals were there. Factories cooling, crop prices slipping, Europe strained and short on gold. Optimism drowned out caution, until it didn't. Black Thursday lit the fuse. Black Tuesday blew the doors off. Crowds gathered outside the New York Stock Exchange, stunned, as paper wealth evaporated in days. But the crash was the spark, not the fire. The inferno came from what leaders did next, in the name of stability. The 1920s roared, jazz, cars, skylines. The U.S. became banker to a wounded Europe. Credit was cheap and everywhere. A young Federal Reserve allowed easy money. Banks let everyday workers buy stocks on thin margin. The Dow soared, headlines cheered. But prosperity built on leverage is a house on stilts. When confidence slips, the stilts snap. After the crash, the Federal Reserve faced a fork: flood the system or defend the dollar. With gold still the anchor, they chose discipline, tight money to protect convertibility. Liquidity vanished. Bank runs spread. Between 1930 and 1933, thousands of banks failed, lines formed, vaults emptied. This wasn't just stocks collapsing. It was money itself seizing up. Under the gold standard, currencies were chained to a metal. If gold flowed out, governments raised rates, cut spending, and ground wages lower, anything to pull gold back. The result was synchronized deflation. Britain's jobless ranks swelled. German misery deepened and radicalized politics. American factories went silent while bullion sat motionless in vaults. The system meant to bring order, spread pain with machine-like efficiency. By 1931, pressure on the pound became unbearable. Britain stepped off gold. The currency fell roughly a third, shockwaves globally, but then something changed. Exports stirred, credit loosened, production ticked up. The unthinkable had happened, and yet recovery began. The U.S. held the gold line. President Hoover framed sound money as a moral duty. Prices dropped by a third. Farmers dumped milk they couldn't sell. Unemployment and bread lines grew. The dollar's strength offered little comfort to empty dinner tables. In 1933, Franklin Roosevelt closed banks nationwide, resetting the system. Then came Executive Order 6102. Americans had to turn in most gold at $20.67 an ounce. Soon after, the government reset gold to $35. Overnight, the dollar was devalued, and purchasing power shifted. It was a massive wealth transfer wrapped in the language of recovery, and it worked at unfreezing the machine. America moved. Others followed. The 1930s became a contest to cheapen currencies and export pain. Tariffs climbed, trade sagged, and the world fractured into currency blocks: sterling, dollar, yen, gold. Globalization ran backward. This wasn't cooperation, it was survival. Economic collapse breeds extremes. Germany's mass unemployment helped propel Hitler. Japan's militarists promised rescue through empire. Italy glorified the state. In the U.S., federal power expanded dramatically under the New Deal. Different flags, same route, monetary failure reshaped politics. By the late 1930s, recovery showed, but heavily managed. Public works built bridges and paychecks. Rearmament finished the job. After World War II, a new order emerged: Bretton Woods. Currencies pegged to the dollar pegged to gold. Gold flowed to Fort Knox. The United States became the world's balance sheet. The Depression is remembered as an economic tragedy. It was also a power transfer. The gold standard didn't die because math failed, it died because it constrained political choices. On gold, austerity and unrest. Off gold, inflation and control. Either way, influence moved upward, from savers to states. Fast forward, 2008, then 2020. Banks wobble, credit freezes, this time central banks print at scale. Instead of deflation, policymakers pick inflation. Instead of failure, they choose rescue. Results rhyme with the 1930s. Concentrated power, eroded trust, and an economy that only works when the referee intervenes. Every era believes its money is safe, its leaders steady, its system durable, until it isn't. Under gold, money enforced discipline. Under fiat, it enforces policy. In both cases, money is a tool, and when faith fades, tools are turned inward. Defend the currency. Stimulate demand. These are battle plans, not buzzwords. In the 1930s, defense meant deflationary pain. Today, stimulus often means inflationary erosion. Governments endure, banks adapt, households absorb the hit. The Depression didn't end capitalism. It transformed it, from gold-backed promises to promise-backed money. History doesn't repeat, it syncopates. High debt, wild speculation, central banks as both arsonists and firefighters, think 1970s, 2008, 2020. Each cycle weaponizes money. Each cycle spends down trust. The Great Depression was the first global financial war. Every crisis since has been another campaign in that same conflict, over trust, control, and the value of everything you own. When headlines scream about the next market scare, don't just watch the chart. Watch the money rules, who writes them, who benefits, and who pays. If this gave you a clearer map of the past and the present, tap subscribe. The playbook isn't hidden in the future. It's right here in the history of money.